Welcome, everyone. Today we're diving into the absolute essentials of the stock market. Whether you're looking to start your investment journey or just want to understand how all of it works, this guide covers everything from stocks to bonds to building real wealth over time. Before we begin, a quick reminder this is only for educational purposes. Investing involves real risk, so always consult a professional if you're unsure. Now let's talk about why you need to invest. It's because of inflation, the silent wealth killer. If your money is just sitting in a savings account, it's actually losing purchasing power every year as costs for goods and services rise. To maintain the same lifestyle your parents had on $1 million, you might actually need $10 million in the future. This is where the stock market becomes your most powerful ally. So, what exactly is a stock? Simply put, it's a unit of ownership in a company. When you buy a share, you become a shareholder, or a part owner. This means you have equity, or a stake in the company's earnings. As the company performs well, the stock price rises, and the value of your ownership increases. These shares are traded on the stock exchanges, which are digital marketplaces where you can buy pieces of global giants like Apple or Tesla instead of household goods. You don't need to be a genius trader to build wealth. You just need to understand compounding. Simply put, you buy quality companies and let them grow over time. Look at the data. If you invested $1,000 in the S&P 500 back in 2015, that single investment would have grown to approximately $3,667 by 2026. That is a nearly 4 times jump just by being patient and staying invested. Compounding follows an exponential curve. In the first 5 years, growth almost feels small and almost boring. But this is where most people give up. But look at what happens around year 20. The curve turns vertical. By year 25, you can actually quadruple your total wealth in just 5 additional years. The magic happens at the end, but only if the discipline to wait for it. Compounding might sound great, but there is some things that could significantly reduce its viability, like panic selling during market turndowns. Investors lock in losses and often miss the recovery. Trying to time the market, even a few missed best days, could drastically reduce long term returns. Starting too late, delaying even a couple years, can mean losing decades of growth. Real world data shows that the S&P 500 has averaged 10% annual returns. A $10,000 investment in 1980 would be worth over $1.2 million in 2026. The best time to start was yesterday, but the second best time is today. Before you trade, you need to know the language. You'll see ticker symbols like MSFT for Microsoft. You'll choose between market orders for immediate buys or limit orders to wait for a specific price. You'll also hear about bull markets, when things are looking up, because when a bull charges, it points its horns upwards, and bear markets, when prices drop 20% or more, because when a bear attacks, it swipes its claws downward. For many, the best way to start is with ETFs, or exchange traded funds. These are baskets of stocks that let you own hundreds of companies with a single purchase, giving you instant diversification with low fees. To evaluate a stock, look at the PE ratio, which compares price to earnings to see if a stock is expensive or cheap. The market cap tells you the total value of a company, differentiating giants from small and upcomers. Lastly, volatility measures how wildly price swings. Tech stocks often have high volatility, big swings, while utility companies usually have a low volatility, a steadier ride. If stocks are the engine of your portfolio, providing speed, bonds are the brakes and suspension. When you buy a bond, you aren't an owner, you're acting as the company's bank. You exchange the high speed potential of stocks for a contractually guaranteed stream of interest payments and the eventual return of your original loan amount. The main reason to keep bonds in your portfolio is because they provide predictable income. Fixed rates mean knowing exactly when and how much cash flow arrives. Capital preservation, generally less volatile than stocks, 20% weekly drops are pretty rare. And safety hierarchy. In bankruptcy, bondholders get paid before stockholders, a more secure fallback. Bonds serve as the ballast of a ship, keeping it steady during storms, which does the same for your portfolio. It balances out the risk and growth. But bonds aren't entirely risk-free, as there are two main things to watch. First is the interest rate risk. When general market interest rates go up, the value of your existing bond goes down. The second is credit risk. The risk that the company or government you lent money to might face financial trouble and be unable to pay you back. Dividend stocks offer a unique sweet spot between stocks and bonds. They provide regular income through payouts. But unlike bonds, those payouts can grow over time as the company's profits increase. This provides an inherent hedge against inflation. The dividend yield tells you exactly what percentage you're getting back in cash every year relative to the stock price. The golden rule to investing is don't put all your eggs in one basket. A resilient portfolio balances different types of stocks. You have growth stocks like Amazon that reinvest everything to expand rapidly. Then there are blue chip stocks, which are stable industry leaders that have reliable growth and dividends. Finally, value stocks are hidden gems, trading below what they're actually worth. Balancing these helps protect you during market corrections while still positioning you for growth. You might hear about hedge funds, private vehicles for wealthy investors using complex strategies. While they sound exclusive, they often come with high fees and lockup periods where you can't touch up your money, or otherwise low liquidity. The reality is that most hedge funds actually struggle to be a simple, low cost index fund after all those fees are taken out. For most of us, sticking to diversified ETFs is a much more effective strategy. By learning this language and embracing the power of time, you are already ahead of 90% of the population. Stay patient, stay disciplined, and let compounding do the work for you. As Vanguard founder John Bogle said, the people who succeed are the ones who are patient and disciplined. Thanks for watching and happy investing. Also, make sure to subscribe if you like this content and want to watch more of it.